Welcome everyone. Okay. Welcome everyone and thank you for attending NESS seminar today focusing on retirement. I'm just wondering if everyone is able to see my slides. Bear with me, I've got some people who can't see. Okay, so other people can see, great. Thanks, Ryan. All right, we're up and running here, thank you. Okay, my name is Therese and I'll be presenting the seminar today. Now, in order for us to get through the content, I would ask that if you have any questions, that you leave these until the end of the seminar. And if you're attending online, we ask that you use the chat option at the top of your screen, and we will also try and address these at the end. Now, if we don't get to your questions or feel that the question is more personal in nature, we will arrange for someone to contact you personally. Now let's begin. Now, the information presented in our seminar today is correct as at the date of our presentation. So it is important to note that this information can change over time. The content is also general in nature, and as everyone has different personal, financial situations, objectives and needs, you do need to consider this before making any decision. If you need advice that is tailored to you personally, then we have advisors that can assist you with this. We will provide contact details at the end of the seminar. So what are we trying to accomplish? Well, we would like for you to be able to walk away with a better understanding of retirement income needs and what you can do to improve your retirement outcome. We will look at things to consider when determining how much you need in retirement, and then finish off with some information on the age pension. At NESS, we want to be able to help you achieve your desired retirement income, so we have advisors that are here to help. Just remember, it's never too late to start to contribute into super, but the earlier you start, the easier it will be to build up your super over time. So how much do I need to retire? Now, this is a common question that our members ask. They're generally concerned that they may not have enough. But when we ask them how much income they need to meet their living expenses or their lifestyle needs, they find it very difficult to come up with an amount. Now, the Association of Superannuation Funds of Australia have developed something called the ASFA Retirement Standard. This provides a detailed budget breakdown for the average Australian to fund a comfortable or a modest standard of living in retirement. Now, a modest standard of living is considered better than the age pension, but it still only allows for the basics. Whereas a comfortable retirement lifestyle includes leisure and recreational activities and provides a good standard of living. It includes some domestic and occasionally international travel. Now, both of these budgets assume that the retirees own their home outright and they're relatively healthy. So it's important to note that some retirees may need more than this, especially if they wish to travel overseas regularly, still have a mortgage, have more than one motor vehicle, or they have additional medical expenses due to ill health. Now, the AFSA budgets for those aged 65 to 84 for a comfortable retirement, $72,663 per annum for a couple, and $51,630 per annum for a single person. They state that a comfortable retirement will allow you to maintain a good standard of living. It will allow for daily essentials, including groceries, transport and home repairs. It also allows for private health insurance, a range of exercise and leisure activities, and the occasional restaurant meal. Be mindful though, it only includes one domestic holiday each year and an international trip once every 7 years. Now, for a modest retirement, as for budgets for those 65 to 84 again, $47,387 per annum for a couple and $32,915 per annum for a single person. A modest retirement budget is for a retirement lifestyle that is just slightly above the age pension, and it allows for basic health insurance and very limited exercise, leisure and social activities. This slide just provides a snapshot of some of the things ASFA has budgeted for when compiling this standard. Now, at the bottom of this slide, we've also provided a link so you can obtain some further information on the breakdown. Now, in later stages of life, the budgets for those 85 plus for a comfortable and modest retirement are lower than those in the 65 to 84 age bracket. Now, this is because ASFA assume that people in this age bracket no longer drive the car, so they have lower transport costs, and that you become less socially active as you get older. But some of these savings are offset by an increase in medical costs, obviously due to the increased chance of illness in later life, and the need of possible household assistance. Now, this does not include the cost of going into aged care, which would be in addition to this. So how much super is enough? Now, once again, ASFA has provided some limited information on the superannuation balances required to achieve a comfortable retirement at age 67. Now, when determining these figures, they have assumed that you are entitled to the age pension to supplement the income from your super. So we've looked at the ASFA retirement standard and what the average Australian needs to fund a comfortable or modest standard of living. But what about you? How much do you need to fund your own retirement? Well, there's a few things you need to consider. If you have more than one motor vehicle or other assets, such as boats and caravans, then your transport costs will increase. If you plan to travel more than once a year domestically and once every 7 years internationally, then your travel costs will also increase. If you still have a mortgage, then you will have mortgage payments. And if you rent, then this will also be an additional cost. If you have a medical condition, you may need to spend more on medication costs. And if you have a large family, then you might spend more money on gifts or looking after your grandchildren. And if socially very active and you regularly go out for dinner, then you're going to need more money to fund your entertainment expenses. Now, these are just some of the things that need to be considered, but there may be more, including capital expenses during your retirement. So we suggest that you do your own calculations to determine how much income you will need. moneysmart.gov.au has a budget calculator that can assist you to do your own retirement budget. It's a great tool. It lists a majority of everyday expenses, and it's very easy for you to complete. Once you've completed this, then you need to consider what costs you'll no longer have in retirement and then make allowances for additional expenses. For example, travelling more. Now, let's look at where money comes from to fund your retirement. There are 3 pillars of Australia's retirement system. They consist of compulsory savings through the superannuation SG, voluntary savings through additional superannuation contributions and other financial or non-financial assets, and a publicly funded and means-tested safety net in the form of the age pension. Now, the primary purpose of Australia's retirement income system is to allow Australians to achieve adequate income in retirement. It's not really intended to boost your private savings, nor is it meant to be used for the purchase of larger assets or to provide inheritances. This is the reason access to superannuation is restricted before preservation age, why there are minimum drawdowns in superannuation pensions, and why the age pension is income and assets tested. Now, the role of superannuation in providing income in retirement. Well, compulsory superannuation was initially introduced to counter concerns that people do not voluntarily save for their retirement. The government has made it compulsory for employers to contribute 11.5% of your ordinary time's earnings into super. Because of this system, future retirees will achieve a higher level of retirement income than ever before. And it will also reduce the dependency on the age pension, which has been a concern due to the ageing population. So the government has tax incentives to encourage you to personally contribute into super to achieve an even higher level of retirement income. They do this by reducing the rate of tax on earnings in super to 15% rather than your marginal tax rate, and allowing you to reduce your personal income tax on certain super contributions. Another incentive to save money for your retirement in super is the ability to access a tax-free pension with the money you have saved in super. That's right, it's a completely tax-free environment for your super savings that pays you a regular income. So when you turn 65 or earlier, if you retire prior to 65 and you meet a condition of release, then you can access a tax-free pension. This pension pays you regular income, which you can use to fund your retirement expenses. The pension payments and all earnings on the funds invested in the pension are tax-free. But you must draw a minimum pension payment each financial year, whether you need it or not. Currently, for someone aged 65 to 74, this is 5%. If you're less than 65, the minimum pension payment percentage is lower. And if you're 75 or over, then the minimum pension payment percentage is higher. And there are limits on the amount of funds that can be moved to a pension. The limit is fairly generous. It's currently $1.9 million. So if you're concerned that you will not have sufficient funds to provide you with the income you need in retirement, then there are things you can do to increase what you have and reduce tax at the same time. They include contributions such as salary sacrifice contributions, and this is where you ask your employer to make contributions on your behalf from your pay. This effectively reduces the amount of personal income tax that you pay, allowing you to contribute more than you could otherwise. Now, while salary sacrificing before tax can reduce your personal income tax, the contributions are also taxed at 15% going into your fund. Thus, your marginal tax rate plus the Medicare levy must be more than the contributions tax for there to be a tax advantage. We commonly get asked, should I salary sacrifice? And the answer is sometimes, it depends. In some cases, it may provide a benefit, but not always. And that's where personal advice is important so that your personal circumstances are assessed. If you currently do not pay personal income tax, then it may not be the right strategy for you. And there may be better ways to contribute to super. You can also make personal member contributions to super. Now, personal concessional or pre-tax contributions are contributions that you make personally into your super fund, and then you claim a tax deduction for the contribution. They're also known as deductible contributions. They aim to increase your superannuation savings tax effectively or reduce your tax. Once again, the suitability of making these types of contributions depends on your personal circumstances, and personal advice may be needed to ensure that these types of contributions are appropriate. One thing to note is that when you make these types of contributions, you do not receive the tax benefit until such time as you lodge your tax return. Now, when making concessional contributions into super, there are limits. These limits are called caps. Okay, so what are the caps? Well, the general concessional contributions cap for the 2024-25 financial year is $30,000. Now, this includes contributions such as SG contributions, salary sacrifice contributions made before tax, additional employer contributions, and deductible contributions. Now we're going to look at an example. Here we have an employee on $90,000 per year. His employer pays SG contributions into super for his employee of $10,350. That is 11.5%. Now, this employee also salary sacrifices $100 a week or $5,200 a year. So the total amount of concessional contributions for the financial year is $15,550. Now, as the concessional contributions cap is $30,000, he's well within the cap and he could contribute a further $14,450 into super, either via increasing his salary sacrifice or making an additional contribution to super and claiming a tax deduction for it, and still be within the cap. Now, although the general concessional contributions cap is $30,000, you may have a higher cap. Why is this? Well, to assist those who have not been able to contribute in the past but are now in a position to do so, there is the ability to use prior year's unused concessional contribution caps if your total superannuation balance is at the 30th of June of the previous financial year is less than $500,000. You're able to use unused concessional contributions caps from the previous 5 financial years if you exceed the general concessional contributions cap of $30,000. I'm now going to show you how unused carry-forward contributions would accumulate if your total superannuation balance, or TSB as we call it, was less than $500,000 as at 30th of June 2024. Now, firstly, as at the 30th of June 2024, the member's superannuation balance was less than $500,000. This is very important. If it is over this, then the member cannot use any unused carry-forward concessional contributions. That is, they're going to be restricted to the general cap of $30,000. If you look at the first column, we can see that in the 2019-2020 financial year, the general concessional contributions cap at this time was $25,000. So the maximum cap available was $25,000. Now, employer SG of $9,500 was made, but no other concessional contributions. So at the end of this year, there are $15,500 unused concessional contributions accrued. Now let's look at the next year, 2020-21. The general concessional contributions cap for this year was again $25,000. But in the second column row, you can see that there's $15,500 unused concessional contributions from the previous year that's carried forward to this year, making the maximum concessional contributions cap now $40,500. He once again did not use the full general contributions cap, nor the amount carried forward from the previous year, so this has again carried forward to the 2021-22, then 2022-23, and then 23-24, resulting in total unused concessional contributions of $78,500 at the end of the 2024 financial year. So if we look at the final column in the 2024-25, we can see that he's got the general contributions cap, which is now $30,000. He also has $78,500 accrued that's been carried forward. So for this financial year, his maximum cap is now $108,500. Now we're going to look at an example where a member wants to contribute more than the general concessional contributions cap in this financial year. So in this example used, the member is earning $130,000. He has no other income. He has a total superannuation balance of, say, $300,000. So he's under the $500,000 required to access unused carry forward concessional contributions. In the right-hand column, you can see that the member makes a personal concessional contribution in the financial year of $50,000. He doesn't exceed his cap, as he has the general contributions cap of $30,000 and unused concessional contributions of $78,000. So this effectively reduces their taxable income from $130,000 to $80,000. Now, as a result of this, the amount of income tax they pay reduces from $32,388 to $16,388. Now, that is a personal tax saving of $16,000. Now, if they salary sacrifice this amount, then the tax savings will be reflected in their pay each week, fortnight or month, depending on when they are paid. If they make the contribution as a deductible contribution, the tax savings will be received when they lodge their tax return. The total tax savings. Now, it's important to remember that as there is a tax benefit when the contributions are made into super, there will be 15% tax payable on the contributions going in. If you look at the example, you will see that if the member did not make any concessional contributions in the left column, the member would pay $32,388 in personal income tax. Then he would also pay contributions tax on any SG contributions made by his employer of $2,242. This is paid by his super fund. Therefore, the total tax payable by the member personally and the contributions tax payable equals to $34,630. In the right-hand column, if the member made the $50,000 concession contributions to super, then the member would pay $16,388 in personal tax, a reduction from $32,388. But contributions tax would now increase from $2,242 to $9,742, as contributions tax is now not only payable on the SG contribution, but on the concessional contribution paid by the member. So the total tax saving for that financial year would be $8,500. Now, if you're a high income earner, then you may be subject to Division 293 tax. This is for if your combined income and concessional contributions for Divisional 293 purposes for a financial year exceeds $250,000. If that's the case, then an additional 15% tax on all or part of the concessional contributions going into the fund will be applicable. So what else can I do to increase my retirement income? Well, you can also make non-concessional or after-tax contributions to super to increase your retirement income. Now, these are contributions you pay personally into your super fund, but you do not claim a tax deduction for. That is, they don't reduce the amount of personal tax that you pay, but your fund also does not have to pay contributions tax. Their main aim is simply to build your superannuation. Now, the limit on non-concessional contributions, the standard non-concessional contribution cap for the 2024-25 financial year is currently $120,000. Now, to be able to utilise this cap, a member's total superannuation balance must be less than $1.9 million as at the 30th of June of the prior financial year. If this is not the case, then the member's non-concessional contributions cap will be nil. In other words, you cannot make any non-concessional contributions to super. Now, you may bring forward up to 2 years' worth of non-concessional contributions caps in the current year, allowing you to potentially contribute up to $360,000 without exceeding the non-concessional contributions cap. Now, unlike unused concessional contributions, which look back at what you've done in the past, this looks forward to the future. In other words, if you have utilised all of your bring forward contributions in this financial year, you'll be unable to make non-concessional contributions in the 25-26 and 26-27 financial years. It is also important to note that the ability to utilise the bring forward rule also depends on your superannuation balance. Another way to increase your super savings and increase your retirement income is to make a downsizer contribution. Now, if you are 55 or over, you can contribute into super all or part of the proceeds of the sale of you or your spouse's home up to $300,000 per person. This means a couple could contribute up to $600,000 into super between them. There is no upper age limit. And before you ask, you're not able to claim a tax deduction for these contributions, but it does not attract contributions tax going into the fund. There are some eligibility requirements, such as the home must have been owned for 10 years or more prior to the sale. The contribution must be made within 90 days of settlement, and you must not have previously made a downsizer contribution. And you must have lived in the home for all or part of the ownership period. So things like vacant land and investment properties that you've never lived in do not qualify. So if you'd like to contribute to super, but you don't have the money to do this, and you've reached your preservation age, then you may be able to access funds from your superannuation via a transition to retirement pension strategy to increase your contributions to super, resulting in a higher superannuation balance at retirement. Remember, a higher superannuation balance will result in higher income in retirement. A transition to retirement strategy involves moving a portion of your super into a transition to retirement pension. You are then able to draw pension payments from the new transition to retirement pension. These pension payments can then allow you to contribute funds into superannuation tax effectively, with the net balance being a larger superannuation balance. There are some restrictions on a transition to retirement pension. You must draw a minimum pension payment of 4%, and the maximum you're allowed to withdraw is 10%. Our NESS advisors are here to assist you to determine whether this type of strategy is suitable, but we'll go over an example for you. Now, this member is age 60 and he's still working, and he commences a transition to retirement strategy. In the example used, the member is earning $100,000. He has no other income. The member commences a transition to retirement pension at the beginning of July 2024, and he draws a pension payment of $12,580, as seen in the right-hand column. This actually allows him to salary sacrifice $18,500, reducing his personal income tax from $22,788 to $16,868 for the financial year. As a result, his after-tax pay doesn't change, but he's able to increase what is being contributed to super. So although there is a reduction in personal income tax of $5,920, tax will be payable on the contribution going to the fund at 15%. So in the example shown, the total tax saving for the 2023-24 financial year would be $3,145. You're also able to make the contributions into super personally and then claim it as a tax deduction, but the personal income tax savings of $5,920 are not going to be received until after you lodge your return. In the above example, we also haven't considered whether the member has any unused carry forward contributions if their balance is under $500,000. So if so, then the member may be able to contribute even more into super and increase their tax savings and superannuation balance even more. So can anyone contribute to super? Good question. There are some age-based eligibility rules that must be satisfied in order for a fund to accept contributions. Now, if you're older, there is good news, as these were relaxed on 1 July 2022. So if you're under the age of 75, then a fund can accept any employer contributions or personal contributions. Previously, you had to meet a work test once you were 65 or older to contribute. So if you're aged 67 to 74, though, if you want to claim a tax deduction for any contributions made, then you will still have to meet the work test or a work test exemption in the year. The contribution is made exemption in the year the contribution is made to claim a deduction. Sorry. So if you're 75 and over, then only mandated employer contributions and downsizer contributions can be accepted. Now let's look at the last pillar of Australia's retirement system, the age pension. The age pension is a government payment to Australian residents who have reached age pension age. It's currently 67 years of age. Now, the age pension was introduced in New South Wales in 1900. The age to be eligible for the age pension at that time was age 65. When the age pension was introduced, people were expected to live to age 55. So if you do the math, most people would have died before they were eligible for the age pension. Since then, the age to be entitled to the age pension has only increased by 2 years to age 67. But the life expectancy at birth is now 81.2 years for males and 85.3 years for females. In most circumstances, to receive this payment, you must also be an Australian resident, normally for at least 10 years. You must also meet an income and assets test. So once you've met the residency requirement, you're then assessed under the income and assets tests. The income and asset test depends on whether you are single or a member of a couple. It's important to note that even if only one member of a couple are applying for the age pension, the income and assets of both parties will be assessed. The amount of income and assets that you are allowed to have before affecting entitlements is different if you are single or a member of a couple. That is, the limit for a couple is higher than for a single person. And the test that results in the lower rate out of the income and assets test applies to your pension payments. But as before, I mentioned that the amount of assets you're allowed to have depends on whether you're a homeowner or a non-homeowner. Let's look at the assets test first. So once Centrelink have determined whether you're single or a member of a couple and whether you're a homeowner or a non-homeowner, they will assign you with an asset-free area and an assets limit. If you're single and a homeowner and have assets of $314,000 or under, which includes your super, you'll be assessed as being eligible to the full age pension under the assets test. If the assets are $686,250 or above, you'll exceed the assets test and receive no age pension. Now, if your assets are over the 314 but less than that 686,250, then your age pension entitlement will be reduced by $3 per fortnight for every $1,000 of assets above the lower limit of 314,000. Now, on the right-hand side, if you're a single non-homeowner, then the assets-free area and assets test limits, as we mentioned, is higher. You can have assets of 566,000 or under. Then you'll be assessed as being eligible to the full age pension under the assets tests. And if your assets are 938,250 or above, you will exceed the assets test and receive no age pension. And once again, if your assets are between those limits, then they will reduce by $3 per fortnight for every 1,000 above the lower limit. Now, if you're a couple and a homeowner on the left-hand side and have assets of 470 or under, then you'll be assessed as being eligible for the full age pension under the assets test. If they're over 1,031,000, then you exceed the assets test and receive nothing. On the right-hand side, if you're a non-homeowner and your assets, if you're a non-homeowner and your assets are over 722,000 or under, then you will receive the full age pension. If there are 1,283,000 or above, you'll exceed the assets test and receive no age pension. And once again, assets between those limits will be reduced by $3 for every 1,000. Now let's look at the income test. Now, Centrelink assess gross income from all sources. So some common types of income include income from employment, income streams, net rental income, net business income, and deemed income from financial investments. It also includes income from overseas. So for those who have reached age pension and still working, there is an income test concession. The first $300 per fortnight of employment or self-employment income is excluded from the income test, and any unused amounts can also be accrued to offset future employment income up to a maximum of $11,800. Once again, the income-free area and income-free limit depend on whether you're a single or a member of a couple. It does not consider whether you are a homeowner or a non-homeowner. The income-free area for a single person is $212 per fortnight, so any income up to this amount does not affect your age pension entitlements. But once your income per fortnight reaches $2,444.60, or the income limit, you will not be entitled to any age pension. Now, every dollar of income above the income-free area of $212, but under the income limit of $2,444.60, will reduce your entitlement by 50 cents per fortnight. Now, the income-free area for a couple is $372 per fortnight. And once your income per fortnight reaches $3,737.60, or the income limit, you will not be entitled to the age pension. Now, every dollar of income above the $372, but under the $3,737.60, will reduce your entitlement by 25 cents per person per fortnight. Now, the maximum age pension for a single person, inclusive of all supplements, is $1,116 per fortnight, or $29,034 per annum. The maximum age pension for a couple combined, inclusive of all supplements again, is $1,682 per fortnight, or $43,752 per annum. Now, remember, if you're a member of a couple, but only one of you has reached age pension age, you will not receive the single age pension of $29,034 per annum. You will receive $21,876 per annum, which is half of what you would receive if you and your partner were both entitled to the full age pension. Now, if you want to contribute to your NESS Super, you can simply log on online to your account and use the unique BPay details on the payment options page. If you wish to salary sacrifice, then you must arrange this with your employer. And don't forget, our member service team is available 8:30 a.m. to 6 p.m. Monday to Friday to help with all your super needs. We're hoping that some of the things we've discussed today have increased your overall education around retirement income and ways to increase this. At NESS, we have advisors who are willing to assist you to relate this information to your own personal circumstances, and we hope that you feel comfortable reaching out to us. Good news is, if the advice is simple advice relating to your NESS Super account, the cost of this advice may be covered by NESS. Okay, now this slide has the details of the two financial advisors at NESS, myself, Therese Pontifex, and Hernan Reis. We would love to hear from you both. Now, for those of you who have attended in person, we have provided some feedback forms, which we have handed to you today. We'll collect them at the end of the seminar. If you'd attended online, we will have feedback questionnaires for you to complete sent out to you soon. Please take a couple of minutes to complete these forms and provide us your feedback. Whether it is good or bad, it will help us develop better seminars in the future, and we really want to hear from our members. Now that the seminar has come to an end, we'd like to thank you for your attendance, and we will move on to Q&A. So firstly, anyone in the room have any questions? Okay, now let's look to see if we've got any online questions. No. No. Okay, we've got a question from one of our online members. There are two parts to this question. The first part is, how do you set up a regular income stream from an account-based pension? And the second part of the question is it more beneficial compared to drawing money as and when you're required? Okay. All right. To answer this, first of all, you have to be either met a retirement condition of release or be 65 or over to access an account-based pension. So if you meet either of these conditions, you can download the NESS pension PDS from the NESS website and complete the application and send this through to us. If you're 65 or over, you also have the ability to have an option to join online. When applying for an account-based pension, you must nominate a pension payment in the application form of at least the minimum and choose the frequency of your payment. If you're over the age of 60 but under the age of 65 and you're still working, then you can only access a transition to retirement pension. With a transition to retirement pension, you also must nominate a minimum pension payment, but you are not allowed to exceed 10% of the balance of your account, and there's no withdrawals that can be made. So you can withdraw funds as required, but you must also take out a minimum pension payment. So that's if you're in an account-based pension. If you're in a transition to retirement pension, then you can't make ad hoc withdrawals. You can only receive pension payments. So, but some of our members, when they permanently retire after age 60, they do leave their funds in super and then make withdrawals as required. The advantage of this is that you only obviously draw what you need, but earnings on funds in super are taxed at up to 15%, whereas earnings in your account-based pension are tax-free. Also, if you do not meet a condition of release, for example, you may be over the age of 60 and you're still working, you cannot leave your, and you want to leave your funds in super, you cannot make withdrawals as and when you're required. You can only access pension payments via a transition to retirement pension. Now, everyone's circumstances are different, and getting advice would be beneficial in this case to see what option is best for you. We also have another question from one of our members. How do I get access to my super when I retire whilst living in Canada? Okay, well, the conditions to access super while living overseas are the same as if you're in Australia. The funds are preserved until such time as you meet a condition of release. When you retire over the age of 60, you will need to contact NESS and they will provide you with a benefit payment form. And if you meet the conditions, then NESS will pay the funds into an Australian bank account, or they will post a cheque out to you if you no longer hold a bank account in Australia. Another question? Okay, so the question is, can transition to retirement pensions be stopped after a few years if required? Transition to retirement pensions are very flexible. They're flexible in they can be moved back to super if you no longer wish to draw pension payments from them. But you cannot then withdraw funds from your super as a withdrawal if you still need some sort of income. It must be in the transition to retirement pension for you to be able to access pension payments. Hopefully I've answered that question. Any more questions? Okay. All right. Thank you very much for attending.